Okay.
Why am I can't make my... I'm having a hard time making my chat smaller. More if you said we're live?
Welcome to the new studio.
Oh, here it comes. Oh, here it comes.
Are you looking to see if you can see it?
Yeah, I can definitely see it because I'm watching it. So we're going to be able to kind of...
Oh, wow.
That's us. Yeah, welcome to the new studio.
That actually looks pretty good. You can actually see the iPod.
Actually, yeah, you can. That's the for those of you who are just tuning in with us now live.
It's weird that there's a 20-second delay on that, though.
That is the iPod that the money guy was
That was
born
smart
off
that
of.
you took that off the screen.
Why?
Because it's weird that it's 20 seconds delayed.
Oh. Why aren't you moving? San Francisco. I've missed the last 3 streams. Hey, Matthew, you said you missed the last 3 streams. You are here at the right time now because we are live in the new studio. So that is awesome.
Oh, now's when we're going to adjust the picture settings? Seriously?
Oh, we got Jessica Torres. Jessica Torres.
That means Drew.
We got Abe Torres too.
What's all that beeping? Is that you?
Hey, Daniel S. He digs the new studio. Guys, if you're wondering, if you're thinking, man, it looks like they're still getting stuff set up. It looks like they're still trying to figure out, where things are and how they go, and
That's a true statement.
that would be an accurate assessment. I am having a real hard time resizing my windows over here.
So is
Sweet studio, guys. Love the new studio. First live stream. Hey, Matt K, since this is your first live stream, I don't know if you know this or not. At the end of these things, we answer a bunch of questions. And when we answer those questions, we like to give away free stuff. So hang out to the end, and we will give some free stuff. Oh, this guy just said, hey, Brian, I recently had lunch with Mr.
Oh, I need to go cut the... Hang on.
He said, hey, I recently had lunch with Mr. Bill Cleveland and found out y'all used to work together.
Oh, yeah.
Yeah. Bill's a good friend. Good friend of ours. All right, I got you.
I was in business with him for... I guess they can't hear me anymore.
Somebody said, need a nice panoramic picture of Ben Hill Griffin Stadium behind you, though. But it must have been that was a typo. It meant Sanford. It meant Sanford Stadium, I think.
We could put a Sanford Stadium.
Oh, hey, Scooter said, a countertainment at its finest. I love that. Live streams are usually, 45 minutes maybe, and then after, and then we do the Q&A. But it depends. Today's a really exciting topic, so who knows how long this thing's going to be, because it's going to be a lot of fun. It's going to be super, super, super valuable.
Morph, how do I look? Did I screw up the angle?
The studio is in the same location, but it's in the same building, but it's a few doors down the hall. So it is a new location, but we didn't get rid of the old location. We just made the adjustment so we can be in the new studio.
And not have to take equipment down every time.
And we don't have to take the equipment down. So when you guys come to
for the
visit
tour.
us, which you should, it is destined that you should, you get to come see us live in the new studio, and we'll even show you the old studio, so you get a kick out of that as well.
Are you running this, or is Matt running this?
I'll need a mouse, and I can do it. Hey, if you guys don't mind, just bear with us. We're still figuring out how all this is gonna work.
Morph, can you hand him that black mouse right there? Bo, keep him off camera. And do you want to minimize these?
Yeah, you can definitely do that.
Are they in the right order now?
I'm gonna have to look at the bottom anyway, so.
All right.
I got one more thing to open up, and then we'll do a test take. And normally, guys, we're much more punctual than this, but this is a.
Why is the taskbar not disappearing now?
I don't have an answer, but I'm big enough they can't see that. They can't see that.
It's fine. For the first live show, it's okay if there's some quirks to it.
I need to find my,
What you trying to find? Your workflow?
well, I got that. I need my worksheet. There we go, live stream. Perfect. We are getting close to not being way off.
Oh man, we're like 5-6 minutes late already.
Why don't you talk a little bit about what we're doing today, Brian?
So
This is just for the YouTube live folks. We're not actually
we haven't gone
live
live
yet.
yet. We're going to be talking about taxes. This is near and dear to my heart. 16 years of experience, and things are a lot different this year. I will tell you that I was kind of shocked when I started looking at all the new tax forms. So we're going to give you a tour of what's changed as well as planning opportunities.
You did say all the new tax forms, didn't you? You said all of the new tax forms.
There's a lot.
All right, Morph, I'm getting really close. So just give me 1 second.
Wow, we should have given you 2 monitors over there.
I know, I know.
You got a lot going on.
Hey, Bill Rauch asked, hey guys, what's 18651? He wants to know about that back there.
YouTube subscribers. So if you give us a quick YouTube subscription, you'll see it go up to 52.
You know what? I'm not used to a trackpad. That's what I'm learning here. Oh, wow. Chris Bayard said, would love to have you guys break down what 2018 tax returns look like so far, after you have the data, of course. Guess what, Chris? That is what today's show is.
Okay, let's do this, because I don't know if it's getting any better.
Yeah, I gotta do some resizing stuff. All right, you ready? Let's do a quick test take, and then we'll go live. More if you good on your end.
Testing 1, 2, 3. Testing 1, 2, 3.
Testing 1, 2, 3. Testing 1, 2, 3. All right. Yeah.
That is distracting.
What, my screen?
It's all right. I'll learn not to look at it.
You just can't look at it.
Y'all don't know I have I'm dyslexic and I have ADHD, so it all kind of works nicely.
Y'all gonna
with
wonder
lots
why.
of distractions.
You're gonna wonder why next week or next time we do a live stream, there's gonna be like a barrier right here where you can't actually see the screen.
It'll be all right.
All right, I think we're good. You ready for this?
I think so.
Let me take a quick swig of water. Morph is good.
A little nervous. I don't know why. We've been doing this for 13 years, but put it in a new studio, and it all of a sudden feels a lot different.
Well, not only do we go with a new studio, we try to add a bunch of different
Gadgetry?
a bunch of different gadgetry, and yeah, that's awesome. Cool.
It's probably going down.
Oh.
Somebody just unsubscribed.
Somebody just trolled us real hard. Awesome. Here we go. Going live in 5, 4.
2018 taxes. Man, talking about Apple Cart turnover, if you need to know what the new forms are going to look like, if you need to know what planning things you need to be taking advantage of, this is where you need to be. Welcome to the Money Guy Show. Center camera? Seriously? God dog it. So I got to do it again?
So for all of us out there in YouTube and Facebook world, if you didn't know, Brian just spoke to the wrong camera. So you're going to get to hear the intro all over again for our iTunes
Who
folks.
knows what it sounds like the
So
second time?
hopefully,
Make it up as we go.
hopefully that's all right with you guys. Welcome to the very first live
So
stream.
that camera.
All right, you ready?
More if you knew I was talking to the wrong camera and you let me finish that.
All right, here we go. Going live in 5, 4.
2018 taxes. Talking about Apple Cart turnover. Okay, one more time.
Going live in 5.
2018 taxes. Everything's different. I'm talking about new forms, new planning opportunities. You're going to need a resource. You're in the right place with the Money Guy Show. Went in a completely different direction.
No, you went a totally different direction, but I think it was awesome. And you know what it reminded me of is when you think about what has happened in 2018, it seems as though the tax structure, tax forms, just like the Money Guy Brian Preston, have gone in a completely different direction than we thought they were going to go.
By the way, welcome to our new studio. If you guys are just now tuning into the Money Guy Show, this is our first episode ever in the brand new dedicated studio.
That's right.
So when you come visit us in downtown Franklin, that's right, we're right above Merity's Bakery. You'll get the Dime Tour, and you'll see our old conference room that was both a conference room and a studio, and now you'll see we actually have a devoted studio. So it's kind of cool when you come and visit us. But here's the thing I want to talk about. 2018 taxes. It's different. I had this show completely designed differently. Bo and I had talked about when we were doing some pre-show prep. We said, okay, this is going to be easy. Let's talk about planning opportunities on page 1. Let's talk about planning opportunities on page 2. Then let's talk about Schedule A, which is itemized deductions.
Because it used to be easy. You could kind of flow through it. You kind of start with your income, and then you had your adjustments to income, and then you had your deduction. Like, it made sense. And maybe it didn't really make sense, but we've just been doing it so long, we were kind of used to it.
I did taxes for over 16 years, represented clients in front of the IRS. So I felt like I had a pretty good understanding of what was going on with the tax filing process. And then when I was doing show prep, I pulled up the new 2018 forms.
Just think, I thought there was going to be a few extra lines. I thought it'd be like the 1040, but
It's
there'd
a
be
lot
like this.
different.
Yeah, it was
a
not,
lot different.
not
So
the same.
here's what I want to do, and this will be the first time. Now, look, this will get easier, Bo. I hate to put you on the spot. Go ahead and bring up the traditional 2017 1040. And you guys, you're going to see it on the screen, especially our live audience. By the way, every other Tuesday, if you want to tune in, we do this show live. We give away stuff at the end. Feel free to tune in with us. And here's what I think is interesting. When you look at the 2017 form, this is what it's looked like for years, really for probably the last 30 years. There's been some changes, added a few line items. But it starts off, you've got your basic information top, your name, social security number, your dependents. Then you go through your income, adjustments to your income. Page 2, we had our taxes and credits. And then you had your other taxes. That's where they caught you up on self-employment taxes, alternative minimum taxes, and those type of things, all the things you dreaded. And then about 2/3 of the way down the page, you had your payments. That's where you had all your tax withholding from your paycheck. You had your estimated tax payments, extension payments. It was all right there. And then at the bottom, you either got told, hey, you owe money, or you get a refund.
That's right.
All here on 2 pages. So when a prospect or a brand new client, when I said, just give me your first 2 pages of your tax return, plus give me your Schedule A, I could pretty much tell you what you had going on in your financial life.
And I don't want to say it was simple, because I don't think anybody would argue that our tax code was simple.
No.
But again, there was some familiarity with it. Once
It was
kinda
consolidated.
Exactly. Once you got the flow down, you could get a lot of information very, very quickly from the original tax return.
So that's old. Out with the old, in with the new. Bo, bring up the 2018 tax return. That's 2017 still. 2017 still. This doing it over your shoulder is getting you, isn't it?
Yeah, it's getting me.
Morph, help him out if you can.
I just got to pull that one over here. Yeah, pull that over there. Just like that, 28.
So Matt didn't. We're gonna blame this on Matt. You know, Matt, who hooks you up with all the tumblers, didn't bring over the 2018 form. We just threw Matt under the bus.
Way under the bus.
So maximize that on the screen then.
Perfect.
So here's what I want you to notice. We didn't cut off the bottom half of that page. Scroll down, Bo. Show them the second half of that form.
Oh, you just mean all the blank white
Keep going.
space at the bottom of the form.
I think the designer of this thing was an owner of a paper company. Look at it. It is now half the page is unused. So page 1 now on the 1040 for 2018 is just going to have your personal information. It's going to have your name, your social security number, your dependents, and your signature line. So they brought page 2 to page 1 on the signature.
That's right.
No other information besides your personal information. Page 2 is just going to kind of be a summary of what you had going on, whether it's your income, your wages, and then basically if you overpaid or if you're getting a refund, It's all right there. And if there's a whole Q&A that the IRS, provided, because people say, well, why did they redesign the forms completely? And they said, look, we wanted, instead of having a 1040 EZ, instead of having a 1040A, instead of having a 1040,
Right.
we want to have just one form that had the flexibility for us, the building blocks for us to make
So
changes
they
in the
wanted
future.
everyone who files, no matter someone starting out or someone who's got the crazy complicated tax situation, to start with the same base is
Right.
what they were hoping for.
So it's the same, and their terminology was building blocks.
Building blocks,
They want
okay.
everybody to have the same building blocks, so it doesn't matter if you're super sophisticated or ultra easy, you're going to file the first 2 pages.
Okay,
So that kind of makes sense. I just don't understand the spacing and the blankness at the bottom of the pages. So, and then here's where additional details added, because in addition to changing Form 1040, they now added Schedule 1, 2, 3, 4, 5, 6.
No, Brian, you must be confused because I know schedules, and there's like schedules A and B, and schedules don't have numbers. They're like schedule
No, no,
A,
no.
B, C,
We've
D,
added
E.
Schedule 1, 2, 3, 4, 5, and 6. And I want to kind of go through each of these really quick, kind of give you a tour. So Schedule 1, if you could pull that up, is the additional income and adjustments to income. Now, what you'll notice is this stuff looks like the old 1040, page 1. It's just, is that not on there
Yeah,
either?
I don't think that one's on the screen either. Keep going though. When you get a second more, if you'll just pull Schedule 1 right over.
Let's hit pause. Matt, can you come in here?
There we go. We got Schedule 1 going right now. All right.
Okay. But if we're going to keep running this problem, I'd rather have Matt manning that computer
Yeah.
instead of us having to hiccup every time.
Perfect.
He hasn't come in here.
There's a little bit of delay. Keep going.
Okay.
Keep going with Schedule 1.
Okay. So Schedule 1, this looks a lot like page 1 of the first. I'll start over. I'm going to need you to hang out in here, and you're going to be in charge. It's fine right now, but when I ask for Schedule 2 and things, if you could pull it over. Okay. You don't have to do it right now, Matt. It's already up on Schedule 1.
Perfect. We got Schedule 1 up. Awesome.
Let's kick it back in. Okay. So as you can see, Schedule 1 is going to look a lot like page 1 of the old return. You're going to have your additional income, that's your refunds, that's your business income, capital gains, those type of things. And then you'll also have adjustments to income.
Right.
This is all the stuff at the bottom, like educator expenses, the IRA contribution, your IRA deduction, your student loan interest, all those things you're used to. But instead of being on page 1 at the bottom half of the return of your 1040, it's going to be Schedule 1.
And that's all Schedule 1 is those 2 pieces, actual income and then adjustments in income. And that used to be the bottom of the page 1040. So
And at least it takes up 2/3 of the page. Because when you see Schedule 2 with the title of tax, so pull over Schedule 2.
that's not the one that you want.
This one cracks me up. I mean, this one, they couldn't have brought this and made Schedule 1 and 2 combined, because
Yeah, or just call it
when you
something
see
completely
this
different.
form, all that's on this form called tax, Schedule 2, is alternative minimum tax, and then the excess premium return, where if you made too much money with the Affordable Care
Mm-hmm.
Act, because you're getting credits on your insurance premiums. If you made too much money, this is where you'd pay it back,
Right.
plus your alternative minimum tax. This is going to be your least favorite form if you're doing your taxes, I
Sure.
would think, because this means you're in uh-oh land.
So not everyone is going to. So everyone is going to have the first page of the 1040. Most folks are going to have Schedule 1. They're going to have some sort of income or adjustment to
Potentially,
income.
yes.
But not everyone's going to have Schedule 2. That's one that may or may not flow.
I think the majority of people will not have Schedule 2.
Okay.
Schedule 3 is going to be non-refundable credits. When you look at Schedule 3, this is where this was typically about a third of the way down on page 2 of the 2017 and before 1040s.
Okay.
Because this is where you get your foreign tax credits,
Yep.
your child tax credits, which are going to be huge under the new tax legislation, retirement savings credit, the residential energy credit if you made some improvements on your house. All that stuff, this is going to be a favorite.
And you said non-refundable credits, right?
Yes, this is non-refundable
So
credits.
non-refundable credits. Just a quick recap of what that is. What's the difference in
That
a
means
refundable
if you
and
don't
non-refundable?
have enough income to generate the taxes these credits cannot be refunded to you. Meaning that if, say you have a child tax credit, now that's what's interesting. That means the child tax credit must be also listed somewhere else.
It is, because there's a portion of it that's refundable, portion of it that's not refundable.
That's exactly right.
Yep. So, and I think what they did is, I was reading an article on this, they made the math so that essentially it works out the same as it has previously, even though the child tax credit doubled year over year. So yeah, so it's going to
probably show up in multiple places. So, but this is your non-refundable credits, meaning that if you don't pay enough taxes, they will not generate an additional refund just from the credits. Number 4, Schedule 4 was other taxes. This is where you're going to have your self-employment tax.
Yep.
This is where you're going to have underreported Social Security and Medicare taxes and things like that, additional taxes on your IRAs, like your early withdrawal penalties, things, no-go land that you don't want to be in, and then household employees. If you have an employee,
Nanny or
the
maid.
cleaning service, something like that, this is where you pay all that. So it's kind of interesting. Schedule 4 is those other taxes. And then Schedule 5, this looks like the bottom of page 2 of
Right.
your original 1040, which was other payments and refundable credits. Now this is where you got the child tax credits and as well as your payments, estimated tax payments, all the things you're taking credit for. And then 2016 is pretty much another nothing burger. This is if you have your Schedule 6 is foreign address and third-party designee. Now, I was curious, all the tax preparers out there, I said, I wonder if they're automatically completing this, because it used to be just a box that you would go on to give your tax preparer permission to talk to the IRS if there was ever a discrepancy. So I've got to believe a lot of people who use paid tax preparers will probably be completing Schedule 6.
So, so we've gone through these 6 schedules that follow the initial page. And unless I'm missing something, it doesn't sound to me like there was anything on those 6 pages that was not previously contained on the first 2 pages of the 1040.
That's pretty true.
So all we really did was just spread them out. It's not like we added anything or changed anything. The operation behind some of the lines might have changed, but the lines themselves are the same as it was. It's just now we have 6 pages instead of 2. Is that my putting it together?
That is a pretty true statement. And here's the other thing I thought was interesting. And you kind of said this in the beginning, Bo, is that we added Schedule 1, 2, 3, 4, 5, 6. I get, okay, if we're simplifying the process, we have pages 1 and 2. Page 1 is just basically your personal information. Page 2 is actually a summary of all the things. And then you have the Schedules 1 through 6. That's probably it if that's all you're filing.
Right.
Here's the crazy part. There's still a Schedule A, which is itemized deductions. There's still a Schedule B for your interest and dividends. There's still a Schedule C if you have self-employment income. There's still a Schedule D for capital gains transactions. There's still a Schedule E if you have flow-through income from a K-1 or rental property. There's still a Schedule F if you have farm income. I think it's madness.
So we've added 6 new schedules, but we kept all the old schedules we still had with the previous tax filing forms.
So, like I said, we're just doing a tour, and then we're going to get into the planning opportunities that we see with the 2018 tax code. But this is not for somebody who wanted to consolidate this thing. Remember, I heard a lot of our elected officials talk about how they wanted this on a postage, a postcard.
A postcard, yeah.
I don't know if they wanted each top of the page to be postcard eligible, but I don't know that we headed towards postcard territory by adding all these different schedules. And it's just kind of out there a little bit to me. I did want to talk about itemized deductions. Schedule A changed a bit too.
I would say it changed a lot because there was there was a huge, big change that took place, that the standard deduction. I think a lot of folks who previously were itemizing are probably going to be in the place now where they might not be itemizing anymore.
There's going to be a lot more of you that are going to take the standard deduction rather than itemizing, because as Bo explained, what used to be like a $12,000 standard deduction has gone to $24,000 for married couples. Single individuals is $12,000. That's substantially higher. Now, what has gone away is that your personal exemptions. I mean, if you were a person that had 4 kids, 5 kids, you got to count a personal exemption on every one of them.
It was like $4,050, I think.
That's all consolidated into the process now. So that has gone away. And that leads to Schedule A, which is your itemized deductions. Few of you are going to need this form, but I want to kind of tell you the things that have changed and things to pay attention to. And we're starting to get into the planning.
This is the
opportunities.
planning stuff.
So
All that beginning stuff was just kind of the logistics.
That was a tour of what's really changed. So here's what I think is interesting on, like, when you look at your itemized deduction schedule, you'll notice medical is always at the very tippity top. And when we had the last tax reform or update to the tax code, I was kind of disappointed that medical expenses, because it's always, and this bothers me. I will tell you personally, I don't like that they do this. Medical expenses, you don't get to deduct unless they exceed a certain threshold of your income, and that percentage changes.
That's right.
Over the past, it used to be 7.5%. That was kind of a standard for many, many years. And then, within the last decade, it went to 10%.
So even if you had medical expenses throughout the course of a year, you would have to, those expenses in total would have to be greater than 7.5%.
Let's give an example. It's going to be easier with an example. If your total income is $100,000, in the past, if your medical expenses didn't exceed $10,000, none of your medical expenses were deductible. And where did I come up with that $10,000? It was because it was 10% of your total income. So the threshold for deductible medical expenses was it had to exceed 10% of your adjusted gross income before it was deductible. That number has now gone down to 7.5%. So the same person that makes $100,000 or couple, now that number is $7,500. So same example, if you had somebody who had exactly $10,000 of medical expenses, in the past, they wouldn't get to deduct any of them because they didn't exceed $10,000. Now, in 2018, they'd get to deduct $2,500 of medical expenses because the threshold went down to 7.5%.
So for years where you have big medical expenses, it's pretty significant. I think that'll make a difference for a lot of folks.
So let's move on to something that some people are not going to like as much, and that's the taxes you paid.
That may be the most watered down version I've heard anyone say that, because I know a lot of folks who are just really fired up about this because there's some huge tax implications to it.
Yeah, it's the SALT limitation. The state and local taxes have now been capped at $10,000.
Yep.
So if you live in a low tax state where your property taxes are low, you
State
don't
income
have
tax.
high, sales taxes, you don't have any income taxes in your state, this doesn't impact you.
That's right.
Unfortunately, if you live and it's on the west and the East Coast, higher tax states, you got crushed by this. Now, I will tell you, fortunately, I want to tell everybody to take a deep breath, because I had a client in Virginia that they were really panicked about this.
Sure.
Did some tax projections for them, and the savings from the tax rates, because remember, everybody's tax rates went down, even with the loss of the local taxes, or the cap, I should say, of $10,000. When we did a tax projection for them at the end of last year, it still showed that there was some tax savings. So I want you to take a deep breath. Some of you still might benefit from the revised tax policy because just the lower tax rates.
That's right.
But there are some of you, especially if you're a higher income person in a higher state income tax area,
you're going to feel this.
You're going to feel this
one.
Sure. So just pay attention to that. That is a big change that has occurred. Interest you paid, we're not going to get into details because it's kind of past, but what is deductible mortgage interest on new homes has changed. Your mortgage lender, your real estate agent is going to explain that, because if you were grandfathered in, if you had an older loan, that stuff didn't really get impacted, but it's only primarily for newer people that came in. So pay attention to the interest you paid. Otherwise, there was not that big of a change on that. Gifts to charity. Because of, this is a planning opportunity. Nothing really changed on gifts to charity, but you do need to change the way you think about gifts to charity. And we're going to come back to QCD in a minute too. I don't want to move past that completely, but gifts to charity, because of the standard deduction being twice what it used to be, there's a good chance you give to church or give to your favorite charity, you might not get to itemize like you did.
Not unless that and all your other deductions are greater than $24,000 for a married couple or $12,000 for an individual.
But that doesn't mean that you couldn't consider lumping, or grouping your charitable contributions. And if you want to keep the cash flows consistent to your favorite charities, I always tell people, go look at some of those charitable gift funds that you see
Great
at Charles
opportunity.
Schwab, Fidelity Investments. They have charitable gift funds where you can contribute to their charitable gift funds, take the deduction in the year. That's how you're going to do the grouping, and then you control the cash flow of when you want to disperse those gifts or those benefits to the charities that you so want to support.
That's exactly right.
I had it on here. Keep me on pace, Bo.
Yeah,
Did
yeah.
we qualified charitable distributions?
that's
Is this
right.
the time to talk
Yeah,
about it,
that's
or do we do it later?
No, it's huge. QCDs are a huge opportunity that have been around for a while, but in 2018, I think they're going to be even more valuable because of how the standard deduction changed.
Yeah, I mean, the biggest thing, we'll come back to it. I'll talk about it a little bit
Sure.
more, but that's probably a great place to leave it. Another big thing you'll probably notice on the Schedule A of what has disappeared from this form. The big part is your investment advisory fees, your tax prep fees.
Safe deposit box.
Your safety deposit box, your unreimbursed employee expenses.
Oh,
So all
yeah.
my salesmen out there, they're driving 40,000 miles a year, you're feeling this. And the fact that your miscellaneous itemized deductions are completely gone off of Schedule A. If your employer, if you are one of these people that has huge deductions from those unreimbursed employee expenses, you might need to be having a discussion with your employer because you're probably recognizing that on your tax return.
yep,
That's
there's gonna be a
that's
big hit.
huge. So that there needs to be some discussion on that. I want to talk about some areas of focus on how to maximize the tax changes that have occurred.
We've already mentioned some of them. A really easy one is looking at grouping charitable contributions or being reticent of what you have in miscellaneous deductions and how you might be able to restructure that. But there are even some things that you can do that don't just affect Schedule A. They actually shift to some of what used to be the front page of the 1040. Now it can be one of the front 6 schedules of the 1040.
So the first area, and you guys are going to know this because we talk about it all the time, I think the biggest legal tax loophole, I use the word loophole, but I did put the word legal in front of it, is retirement savings. Your W-2, this is the time, and I know not all this can be adjusted for last year, but this is the perfect time to look at it for 2019 too, is look at those W-2 reductions. Because that stuff is going to be huge. If you have an employer plan, make sure you give that a look.
Yeah, if the very first thing you have to put on your tax return is what your income is, what your total W-2 wages are, the single best thing you can try to do is get that number as small as possible. And the number one best way to get that number as small as possible is by deferring into your retirement plan. If you're doing pre-tax. Now, if you're doing Roth, it's a little bit different, but it's a great way to decrease what you're paying in income
Even
tax.
those people that are impacted by the cap on SALT, on the local taxes, they could benefit by maybe looking at
That's exactly
lowering
right.
their taxable income. Look at deferred comp. Maybe you're an executive, you have somebody and you've got offered an additional package of deferred compensation or something like that. It's worth looking into. And then, of course, there's the adjustments to income like your traditional IRA, your SEP IRA. For all my people that have side hustles or businesses where they have self-employment income, you can still, with a SEP IRA, go back in time. I know we've
right.
done other shows, we've talked about that, but it is such a powerful thing that it's one of the few benefits where you figure out my taxes are bigger than I thought I would. What can I do? You can still go back to your 2018 taxes and lower them by doing a SEP IRA
That's right.
if you have the right type of income.
And all that's going to be Schedule 1 stuff. Everything we just talked about is going to be stuff that shows up on Schedule 1, right?
That's exactly right. I also want to talk about HSAs.
Oh, yeah.
Health savings accounts. Man, these things get us excited because they are triple tax advantaged. I mean, that just rolls off the tongue so nicely. When I talk about triple tax advantage, I'm talking about you get a tax deduction in the year you make the contribution.
Right.
You get tax-free growth, meaning these assets, as they are growing, because you build them up and they potentially have the opportunity to go invest them in mutual funds. I use personally like some Vanguard funds and things like that. They get tax-free growth. You use them for medical expenses, it's tax-free distribution. That's triple tax advantage. That's powerful stuff. That gets me so excited. And this is the super HSA strategy that I tell people about all the time, and I do this myself. I make the contributions, the maximum contribution each year for my family.
I think in 2019, it went up to $7,000 a year.
Yeah,
I
it's
think.
right around there. So I don't take any distributions from my health savings account. And people are like, wait a minute.
Well, you have medical expenses and you have money in the account. Why aren't you using the money in the account to pay for your medical expenses?
Because I like the ability to let those assets grow. I love compounding interest. So if I can take triple tax advantage sprinkle a little compounding interest in there, it's magical. Because let me tell you how this plays out. What you do is you are building up medical expenses. I just went to the dentist last week, kept my receipts. And what I do is I scan those receipts in for what I had to pay out of pocket into my HSA folder.
Yep.
And I put it by year, and I put details. I have supporting documents. And I've been doing this for the last few years. There's a 2017 HSA file. There's a 2018 HSA file. There's now a 2019 HSA file. And every year when I make my maximum family contribution, I then immediately go and invest that money into a balanced mutual fund that has good growth, but it's somewhat conservative in case I need to actually have access to the money. And then my goal is there's no limit on this. If you go look at the tax code, you could do this. Now, I have a plan. I'm going to probably do it 5 years, 7 years, maybe 10 years. I haven't figured out exactly when. But I will go and add up all those medical expenses for maybe 2 years, 3 years. I haven't figured out how much I want to do. Go get reimbursement, but realize that account has grown.
Yep.
So potentially I will have put in, let's say, $15,000 of HSA contributions, but that $15,000 might now be worth $25,000. I'm going to go get reimbursement on, say, let's just say $15,000.
Yeah.
I will go pull that $15,000 out, but 15 minus 25 does not equal 0.
That's right.
It equals 10. So I will still have $10,000 that will be working, that will just be growth, and that $15,000 I pulled out will be completely tax-free.
That's exactly right. It's a huge planning opportunity. We're amazed all the time that we see folks who have access to HSAs to their employers and they're not taking advantage of it. So make sure as you are talking to your employers, as you are thinking about open enrollment, whenever that is throughout the course of the year for you, if you have a health savings option or if you're in a high deductible plan, it's something you should absolutely be looking at.
I know we've already talked about this, but I think it's worth repeating again, especially for my clients or listeners or Money Guy family members who are retired, who are at the age where meaning they're over 70 and a half and have to take required minimum distributions, and they don't pay much in state income taxes. In other words, they're probably taking advantage of the standard deduction, but they're charitably inclined. This is where the qualified charitable distribution makes complete sense. And I'm even doing this, I don't think my mother-in-law would mind me sharing. She's doing this because I love the strategy because here's what happens in the way this logistically works. You get to give the money to your charity, meaning that you will take a distribution directly from your IRA or 401k custodian. It goes directly to your qualified charity.
Yep.
Now, you will still get a 1099 from your custodian, but that money gets excluded from your income, meaning you did not have to count that money that went directly to the charity as income to you. That's going to help you out. And when you're retired, that's going to help you out in the fact that potentially your Social Security is not going to be as taxed as high. Potentially your Medicare premiums are not going to be as high because all that stuff goes into account on how taxable your Social Security is, how high your Medicare premiums are. All that is grouped together. So that's gone. I mean, or it is impacted by it, I should say.
That's exactly right. And one of the things that we've talked about, and we've kind of thought through this, and I don't want to speak too early on this because we've thought a lot about this, and I don't know that we've caught it completely. There are going to be situations where you might be in the exact same position if you were to do a QCD versus just take the money and give it to charity. But we have not been able to think of a scenario or come up with a scenario where the QCD is not more advantageous or where it's not at least as much advantageous. So if you're someone who's over 70 giving to charity, even if it may not make your situation better, it certainly won't make it worse.
Yeah.
So we think it makes sense for everyone in that realm to start thinking about QCDs.
It's a great planning opportunity. That leads to tax credits. Bo, you got 2 kids, 2 little ones.
That's exactly right.
Tell them what you get excited about with the new tax legislation.
Yeah, so you used to get really excited when you had a kid because you get a personal exemption, right? You get extra life in there, and that would, that's one of the reasons they want to, if you're thinking about having a kid in like early January, you try to like really get that kid out in late December because you get an extra deduction for that. Well, in addition to the personal exemption that we used to have that went away, there was this thing called the child tax credit that for every one of the kids that you had, there was a $1,000 credit that you would get if your income qualified that would help be a direct credit to your taxes. So it was hugely valuable. Well, 2 things that are really, really excited happened in 2018. One, the child tax credit doubled. It went from $1,000 per child to $2,000
Doubled
per
That's
child.
huge.
Doubled. The second thing is there used to be an income exemption on who actually got it.
Or a phase out.
Income phase out.
Yeah.
And if your income for a single individual was $75,000 or for a married individuals $110,000, you began to not qualify for the child tax credit anymore. So a lot of the population fell out of being able to get that. Well, they actually increased the limits to now you're a single individual that can make up to $200,000, or as married couples, you can go up to $400,000.
Booyah! I'm telling you, that is big tax deductions right there.
If you're a higher income individual and you have 2 or 3 kids and maybe you used to not get the child tax credit, you potentially could have gone to where now you have $2,000, $4,000, $6,000 of child tax credit available to you.
Now remember, I threw a little cold water on you guys earlier and said, look, the new tax code does not allow personal exemptions. And that's sad because, those were exemptions that you were lowering your income for each child or dependent that you had by $3,000 to $4,000 per child.
Right.
But here's the thing. That's a deduction. Those exemptions worked as deductions, meaning that you would have to take the amount you deducted, multiply it by your tax rate, and that would actually be your net tax benefit.
That's right.
With a credit, guys, credits are worth a lot more than deductions.
That's right.
It's dollar for dollar tax savings. So when you say it went from $1,000 to $2,000,
It just acts the tax
that's
bill.
huge. I'm telling you, this is more powerful. And then pushing that income limit up to $200,000 for single families, $400,000 for married.
That's right.
Guys, that is massive. So I think that really takes the sting off of doing away with the personal exemption. So think about that. These child tax credits are legit, and that's a huge benefit for a lot of people out there with children.
That's right.
Let's talk about the rest of the return. The big thing, Matt, you've been great. I don't think there's anything else to add. So thank you for coming in and helping us out. I want to talk about the rest of the return. I got this last week. This is my Journal of Accountancy. You see what's on the cover of it.
Of course you get the Journal of Accountants.
I'm a
You're not
CPA.
even technically an accountant anymore. You're like a remnant of what once was an accountant.
Did you just say I'm not an accountant anymore?
I'm just saying, it's not like, was that offensive? Is that a big deal? Is that something? All the CPAs out, I'm going to get so much hate mail
when
for
you
that.
retire, if you like, my mother was a teacher.
You say,
She did it for 4 going on 4 decades. She retired. Is she no longer a teacher? I want you to tell our listeners, look at the camera and tell all of our retired people, our pilots out there who navigated, they were in the military and then they, drove big commercial planes. They're now retired. They work with us. Are they no longer pilots anymore?
I'm not going to answer that question.
I think we've answered the question. So I am still a CPA. You can go check out the license. And my Journal of Accountancy that comes with my CPA membership, the front cover here is QBI, Qualified Business Income. Guys, and we reached out to some of our tax preparers because even though I'm not doing taxes anymore, I still got connections in the CPA universe.
You're still down. I got it.
So I still speak their language. We reached out to them and we said, what's the biggest things you're noticing as you're getting into 2018 tax prep season? And I kid you not, I even wrote it down here. The quote was, oh gosh, where's the quote? It was...
He said, what the one I know you're talking about says, the tax savings I've seen have been enough to knock you over.
That's
when
what
it
it
comes
was.
to QBI.
They're knocking you over. Here it is. The tax savings I've seen have been enough to knock you over. When you hear an accountant get excited, it says it knocks you over. There's 2 things that get accountants excited. When you go to conferences and there's free booze.
Obviously.
CPAs who are very price conscientious love free booze. And then the second thing is when you hear them say, these savings will knock you over. So for a lot of small business owners,
it's going to be big.
This 20%, because that's what QBI is, this 20% deduction off of your qualified business income. Now, I will tell you, there is a laundry list. I opened up this article. I took the sheet of paper out because I gave Morpheus a document out of here. This thing will put you to sleep. But there were so many caveats to the QBI that, guys, you're going to need to make sure you talk to somebody to work you through it because there are some carve-outs for qualified business income, including special service business. Bo, who does that impact?
It impacts us.
Well,
it
besides
impacts us.
I know
But,
selfishly
I know
we
you weren't
look at
asking me that
ourselves, but
question.
who else does it impact?
It impacts those in the following fields: healthcare, law, accounting, actuarial services, performing arts, consulting, athletics, financial services, brokerage service, or any other trade or business that relies on the reputation or skill of one or more of its employees.
That kind of stinks.
So it's pretty encompassing in terms of who this is. And so
You know who they didn't carve out? Real estate. We know how things are buttered up there in Washington. I get it, but they carved out all you professional athletes. You got stuck.
So there's a few things you need to think about when it comes
Entertainers, you got stuck too.
So-
Brad Pitt, you got stuck.
So
Mark
there-
Wahlberg, you got stuck too.
So there's a few things you need to take.
Dave Ramsey.
So there's a few things you need to think about when it comes to QBI. One of them is what field that you work in. Are you someone who works in one of these excluded fields? But the other is there is an income threshold. Below a certain income, it doesn't matter as much. In between
The Rock got stuck too.
one income and another, it does matter. And then over the income, it completely goes out the door. And so if you are below the phase-out range, it's $321,000 to $421,000 for married. You don't have to worry about if you're in one of these qualified service industries because you will still qualify for the 20% pass-through. It's $160,000 to $210,000 for single individuals or head of household. If your income starts getting into those higher ranges, again, it starts at 321 for married, 160 for single, it gets a lot more complicated. If you're someone who's been doing your self-preparing and you've been doing your own return for a number of years, and you are a small business owner, or you have a side hustle, or there's some flow-through income that's coming your way, it might not be horrible in this first year to think about working with a professional just to make sure you don't get this wrong. Because getting this wrong can have some really big implications on how much tax you pay in 2018.
I wanted to say one more thing. Besides, Miley Cyrus is probably going to get stuck on this too. Dolly Parton, she's going to get stuck by this. I mean, anybody who is based upon their specialty skill set, pretty much our elected officials looked at us and go, we don't care if you employ a lot of people, you don't get this 20%. So I'll move on. There's a little bitterness that you can probably sense
it
from
was
it.
so funny. I didn't pick that up.
I do think, in all seriousness, when I talked to this tax preparer, the CPA that we're friends with, who's part of the Money Guy family, and he was telling us that these deductions are looking so good that it knocked him down, it did make me wonder, because I'm always, guys, you want to know what makes you a good investor, what makes you, besides doing it consistent and often and creating and locking it in so where you're saving automatically, it is reading the tea leaves to at least understand what market things might be occurring. And I wrote it down here, Bo, in the show notes, is does this create a small business ripple effect for future growth? I mean, if every one of these small business owners that's not Miley Cyrus or The Rock or,
All the other people that
Coldplay
you
or
named.
everybody else that's out there, do they, when they get that little bit extra bump, when they get their taxes, because we know, look, when the tax rate went down to 21% on corporate America, the stock market was pretty excited about that. But does the same thing happen when Main Street realizes that there might be a little bit extra in their tax refund? Because you wouldn't know that until we now started working through the 2018 tax prep season. I got excited about that.
Yeah, I think it's going to be really interesting to see. I think a lot of folks know that there have been changes. I think a lot of folks know that those changes might hit them. If I'm somebody in a SALT state, if I'm somebody in a certain income range with kids, or if I'm a small business owner, I don't think that most people have a full grasp on just how it's going to hit them.
But it is so complicated that it's the head story in my Journal of Accountancy is that I don't think, even though people think they're hopeful that they might get a deduction on their tax return for their business, they have no idea how big it will be.
That's right.
So
That's
it
exactly
will be
right.
interesting to see if it's a shock and awe moment that creates a ripple effect that's good, or if it fizzles out. It remains to be seen. I did want to throw out one more planning opportunity, because a lot of you guys, when you do your taxes, we got a lot of big changes that are going on from 2017 to 2018. You might realize if you had a good income year that you had an underpayment penalty, and those are my least favorite. When I see penalty, when I see the word penalty, that's not good. Taxes already are bad enough. Our favorite uncle, I feel like, gets a pretty good clip of what we've got coming in. But then when you find out that he wants to put a penalty on top of that's not good.
It's not good at all.
You need to stay out of that zone as much as possible. So I always tell people, if you have bonus income or year-end income, or maybe just one transaction that came in, and now you file, when you file your taxes, you kind of crossed over that threshold where you had an underpayment penalty. Talk to your tax preparer, or maybe your tax preparation software, because 90% of you, according to the IRS, are using tax preparation software, whether it's through a paid preparer or doing it yourself. See if you can't do something to minimize or even do away with that underpayment penalty. A good tactic that I used a ton when I was preparing taxes is what's called annualizing your income, where you would actually, especially if that underpayment was caused by a big bonus you got at year end, if you showed that that income came in right at the end of the year, could reduce how that penalty was calculated because it wasn't an underpayment throughout the year. It was only at the very end of the year. So pay attention to those type of planning tidbits. And maybe your situation's gotten complicated. This is one of those things where we have people who are trying to figure out, do I need to hire a CPA? You know, and look, coming from a background of preparing taxes for close to 2 decades, I think that CPAs add a lot of value. But this is also where maybe, and I'm going to go ahead and say it, a personal financial advisor does not get to take advantage of QBI might be your best friend trying to figure out how to make the best decisions with your personal finance. I mean, who else in the world do you know that goes and gets so excited that they print out PDFs to put on the screen, that print out PDFs? Now, I'm killing just as many trees as the IRS is, but I literally, if you could have seen when I was doing show prep over the last few days, guys, I was yelling through the walls at Bo. I was like, oh my God, Bo, you're not going to believe these forms. They're completely different. We got so excited about it. You deserve to have somebody in your financial life that gets that excited about something as nerdy as what the IRS has done with their tax filing forms.
You know, you said something, Brian, that I thought was so great. You're talking about underpayment penalties, and if you are someone who's been subjected to an underpayment penalty, you might want to make an adjustment. I'm going to throw one other thing out there. We've had a lot of clients who've asked us, they said, look, guys, I know that the tax laws changed in 2018. Should I go ahead and start adjusting my withholding? Should I change my estimates? And our thought has been, hold off. Yeah. We don't really know exactly what the numbers are going to look like. Now, once you file your 2018 return, if you are someone and you get a big refund, and it's likely that that thing that caused you to get a big refund in 2018 is likely to carry forward into future years, you might be someone who does want to consider making some adjustments, because as exciting as big refunds are, in reality, they're kind of just like interest-free loans to the government. Exactly right. So if you are someone who gets that come tax time, think about maybe would I rather spend this money or save this money or get this money working for me a little more throughout the course of the year than waiting till April to get it back.
So guys, check us out, moneyguy.com. If you like the new studio, if you're you might be listening. You've been listening to the podcast for 13 years and you go, wait a minute, I've heard these guys talk about this YouTube. Guys, this is the time to go check out the new studio. Definitely go check us out. You can go to moneyguy.com, go check us out on YouTube, and just type in Money Guy, the Money Guy Show. It'll show up. You look like you have a new idea to show.
No, it's not a new idea. I'm just so excited because what we always do after these live streams is we do this Q&A, and I'm just sitting here going through my head. We're about to have because we have you guys are the smartest of the smart out there listening. I'm so excited about what our questions are going to be today about the 2018 tax law changes, because it's just going to be fun to see where it goes and see how that conversation goes.
So tune into the live cast too. I mean, our live streams are a lot of fun. You'll see, I mean, here's what you guys don't know. We don't edit the show a lot, but today's show, because it's in a brand new studio, there is 1 or 2 major edits that occurred. Because we normally, we hit record and we rip. We let it rip. But today, if you watch the live show, you got to see 1 or 2 fumbles where it required us to actually hit the pause button. But there's no pause from the live stream. So if catching people doing embarrassing things is your thing, you need to be hanging out with us for the live stream, because we try to make it fun. But in all seriousness, moneyguy.com. Make sure you give us your email address, because we have great deliverables on this type of content. And then also, you can get into our archives. All we want to do is have this abundant cycle where you grow, become successful. When you get to the point that you say, you know what, I have built a tremendous amount of assets here. I'm starting to get worried. What do I not know? And I'm at the point that I might screw this up. Give us the opportunity to pay us back by letting us look over your shoulder and tell you where you are with your personal finances. Once again, I'm Brian Preston, your host, with Mr. Bo Hanson. Welcome to the Franklin, Tennessee studio, and we'll be back soon.
More if we good? All right.
First of all, Matt, I know there's a 20-minute delay on this too. Matt, you rock. I felt so horrible watching you just over there breaking your back, standing over the computer screen to drag those tax forms over. So if you want to come in, I'll know that your answer is yes. If you come in after the 20-second delay, I'll give you a personal hug. Let's see if he
Are we
comes
doing
in.
that on camera? Is
Yeah,
that a?
I'll hug Matt on camera. I'll give the silver fox a hug.
I'm super excited. Now, here, I want to put a disclaimer on there.
And I'm not a hugger. That's why everybody internally knows that's a
Oh,
big
that's
deal.
a big deal.
But
We're
I felt
gonna-
bad about Matt having to come in here.
I think we're going to do our best to answer some questions for you guys. And
Now
we're
we
going to
realize we have to record a whole nother show.
I know.
So be gentle.
So I'm just throwing it out there. There's a lot of unknowns surrounding these 2018 returns. So I don't want to say you're going to stump us because, but
I don't want to do a bunch of QBI because
Exactly.
I really read this article and I was like, maybe it's good that I'm not doing taxes anymore because there's a lot of different carve-outs on that.
all right, let me see if I can make this a little bit bigger. And
Do you want a hug? Are you in here for the hug? He just poked his head in. He chickened
he
out.
does not want the hug. All right, let's see. I'll pick a few good ones. Okay, here's one from Sonny, and this is just a good one. It says, you said a lot about HSAs and talking about health savings accounts. Do you have to have a high deductible plan in order to be able to use an HSA?
Yes. I mean,
Okay, I was going to give you a chance to wax a little more on that. Yes, you have to have a high deductible plan in order to take advantage of an HSA. It does not mean, while HSAs are like wonderfully beneficial and they're super, super valuable, it doesn't always mean that you ought to opt for the high deductible plan just in order to get the HSA. You really need to weigh, okay, what does the Cadillac low deductible, really good looking plan at work look like versus the high deductible plan? And I have to bring the HSA savings into the equation, but it's not always one way or the other. It depends a lot on what your employer is doing and how the plan is subsidized.
It really does depend upon how rich your employer's plan is.
That's right.
I mean, but for a lot of your small businesses that are out there, you are going to see, just because those are the most cost effective for small businesses, you will see access to a high deductible plan.
That's perfect. Great question.
Was that Tumblr?
Yeah, Sonny, you get a tumbler. Sonny, you're here. By the way, you're here at every live stream, and we love that. That means so much to us. Thank you. So if you haven't gotten one yet, you get a tumbler. If you have gotten one, you've already got one. So send an email to Matt.
I'm sure Matt's keeping up with that.
aboundwealth.com.
In addition to changing slides in the middle of our brand new studio, he's keeping up with that.
This is a good one, and this one is a good one that doesn't always have an answer because we get asked this by clients all the time, and it's a really hard one. So this is from Cam.
Great. This is a setup.
How do you recommend finding a CPA? I'm adding an extra job as a 1099 employee, and I'm worried about underpayment penalty because of it.
Oh, man.
So-
I mean, it is a hard one.
So two questions. One, how do I find an accountant, right? The second question is, anything I should be thinking about since I'm taking on this side gig, I'm going to get 1099, do I need to be worried about underpayment penalties?
That is multiple questions. So here's the way, and that's gonna be a Tumblr question too. So that way, if I don't answer it well, he'll at least be happy with us. The CPA question first is that the biggest thing is, I mean, I would ask friends and family. I mean, because you can always go the route of go on an aicpa.org and type it in your zip code, and I'm sure that you can find tons of CPAs around you. But I want to give you more of the traits to look for, because it's hard. I'm not going to know who to recommend to you, but here's the traits of somebody who's good. You can tell, and I still have people that I haven't done their taxes in 5 to 6 years who still pretty much annually ask me if I'm ever picking up doing taxes again, is that you have to have that curiosity trait where when you meet with your tax preparer, do you feel like it's a transactional thing where they're only giving you their organizer and whatever you fill out on it, that's all that gets put on your tax return? Or do you feel like they're actually taking a personal interest in your personal tax situation and actually asking you questions? Are they trying to go through and figure out if there's additional opportunities to squeeze better legal tax savings for you? And if you feel like that they really are trying to be a partner with you and maximize, then they will earn. A good tax preparer should be able to earn their fee by finding you those additional deductions, or at least maximizing what you have. Now, I will tell you, I have to always give a disclaimer because we have a client.
And she's going to be listening to this show right now.
She's probably going to be listening. MIT graduate and all the other brilliant stuff. I got her finally to the point that I thought she was going to be working with a tax preparer. I found out she was still doing her taxes independent of the paid tax preparer and then comparing and contrasting
Right.
what the paid person did versus that's not a constructive element because you didn't really relieve yourself of any
Right.
work. So I always have to put that disclaimer out there because of how brilliant she
Yeah.
was, and
Yeah.
obviously if you're doing that, she probably enjoy it. The second part was, how do you avoid underpayment
Well, he said,
penalties?
he said, I'm thinking about taking on a side gig, so I'm going to get this 1099 for my side gig. I'm nervous about underpayment penalty. What can you say to me about that?
Yeah, especially side hustles and things where you get paid 1099. The biggest thing is you do need to be putting the money aside, and then if you have enough of it, there's a good chance you're probably going to need to be making estimated tax payments. I always tell people, the rules, it depends upon where your income is. I don't want to get down in the weeds whether it's 90%, 100%. If you make it over 150,000, if you're doing 110%.
Sure.
Just know that if you have side hustle income and it gets to be where that if you're saving, if you need to pay taxes, because not only do you have to pay income tax, you probably have to pay self-employment tax, which is 15.3%
right.
plus your income tax. That stuff all gets calculated and put on your personal tax return. So it's easy to say that 30 to 35% of every dollar you make as a side hustle might, if you don't
Go
have
to taxes.
expenses to offset it, you probably need to think about it for taxes. And if that number starts getting to $5,000 to $10,000 of additional taxes, you probably are at the point you need to be making an additional estimated tax payment to the government.
That's great. I think that's definitely.
Is that
something
deep?
worth it.
Because that's
No,
such
no,
a
that's good.
personalized question.
That's great. The answer is you want to be holding money back. Now, what that won't help with the underpayment penalty, but that'll help for the penalty of where am I going to come up with the tax bill that I owe, right? So that's the big thing. If
What
do have
you
side
don't
hustle
want to
in-
have happen is you get a 1099 at the end of the year with $25,000 of additional income, and then you didn't take that into
You
account.
didn't know it. That's right. That's right. Okay, I see Morris waving at me. We're gonna do one more. Okay, this one is from Peter. This is from YouTube. He says, "Does making Roth contributions make sense when in the 24% bracket? I can contribute to both a 457 and a 403b. I plan to max out both."
Oh, that's good stuff.
Some really good stuff. I knew you'd like that one. So,
Does the 401k and 457, or does the 401k specifically allow Roth contributions too?
well, he didn't say if it 457 and 403b, which one was Roth. But I will say this. Our general rule of thumb is if you add up your total effective tax rate, and when I say effective, I don't mean like truly effective. I mean like your marginal federal plus your effective state. You add those up. If it's over 30%, it makes a lot of sense probably for you to think about doing pre-tax. If you're below 25% and you add those up, it makes a lot of sense for doing Roth. If you're between 25 and 30, that's where you kind of have to measure.
a gray area.
There's a lot of variables. How old are you? What's the source of your income? When do you plan on retiring? When do you think you need to access the money?
Estate planning
Estate
options.
planning. There's a lot of different things that play in. It doesn't sound crazy in the 24% to be taking advantage of Roth, but there might be ways where you can take advantage of pre-tax savings, but there are other strategies you can use to really grow your Roth assets as well. So the answer is, we love that you're maxing out 457. We love that you're maxing out 403b. And when you get to retirement, we want you to have Roth assets. How you go about doing that is going to depend on your individual circumstances.
Yeah, I mean, having both a 403b or 401k and a 457,
Huge.
man, you'll be a client.
I'm about to say, Peter, let us
part
know
of the
when you're
Money
ready
Guy
to
family
take
and
it
the
to the
Abound
next level.
family in no time. I love it when you get to legally stick it to the government that way. That's awesome.
All right, Brian. So what do you think?
That was a Tumblr too. So
that's
did you get the
Tumblr.
name?
Yep,
So
that was Peter.
Peter, write Matt at aboundwealth.com.
So for the inaugural voyage, yeah, there were some hiccups, but not too bad, right? This worked. Hey, if you guys, this was so great. You guys were chiming in the chat. If you guys have suggestions or there's something you saw, or like, hey, think about this. I've already got a bunch of text suggestions that people have sent us for like how to control the screen more efficiently. If you guys have suggestions,
Growing pains
are there
of improving.
things that you want to see, by all means, reach out to us. Or if you have questions you want to hear us talk about or topics, go out to the website, moneyguy.com. You can submit a topic, ask a question right there. A lot of the ways that we come up with these show topics are coming directly from you guys. So let us know, and we're happy to engage, happy to interact, and we just are so happy you're here.
By the way, all during the show, this thing has been clicking, clattering. I was so sure because we had technical issues that I was going to turn around and we will have lost 12 people because they were like, these dopes. I would not listen to a thing they said because these dopes can't even get the TV monitor to work. But I'm happy to see that number actually went up. So thank you guys for being graceful, being grace-filled and forgiving us as we had these growing pains. Really appreciate it.
Awesome. We'll talk to you in 2 weeks. That's what you always say. But we talk to him more often. We talk like every week now.